All right, so stocks ended up having a really quiet day, which is not normal for a CPI day. CPI came out a little bit hotter than expected, but nothing too major. Obviously, the markets didn't put a lot of concern into it. The question is whether or not that's actually a good thing or not. From a technical standpoint, did that now kind of negate some of the weakness we've seen lately and change our sentiment back to the upside? So we're going to take a look at the patterns to see what our expectations are going forward, to see whether or not we're going to have any more of this kind of slide, which is a little bit of a seasonal period to this slide and increase in volatility, or whether we're going to be able to overcome the seasonality and change the sentiment to the upside and get to where we're back to being pretty strongly bullish. There is, obviously one of the indexes having kind of its own move right now. We'll talk about how telling that is and how it can move the rest of the market with it. And we'll also take a look at the sectors that are making big moves, some cyclical areas of the market not doing so well. We'll talk about which cyclical areas those are and what impact that has on our expectations going forward. And then finally, our trade ideas today is in a sector that's been very strong and starting to lose some momentum, starting to converge a little bit. So we'll talk about how to trade a stock that's been strongly bullish that now is less bullish, and see if we can't profit from that change in sentiment, change in trend. So let's go ahead and get started. Today is Wednesday, September the 13th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things on the right, including our Market Outlook live video here. Scroll down to the bottom, click on this heart. It opens up this tab. Hit that like button. Over here, click the thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So we always ask for it. Our goal is to get to 100. We're getting close. Close, at least on my videos, we're getting close. Like I said, Brandon is getting over 100 and getting closer on mine. So again, thank you to those who do like these day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 on the market forecast indicators. You can see we actually got another bear tag. Again, this is an indicator that typically suggests that a new intermediate trend is beginning, right? Or, so again, a good extended long run is just starting, or it's a bounce signal that we've maintained the trend. So, usually with a pretty decent move to the downside. Now, the last time we got a bear tag signal, it didn't produce either move, and here we are. We've seen multiple tags before, as you can see for an example. So over here we had a couple bear tags kind of back to back. So it's not unprecedented to get a couple bear tags here. The last time we had a couple bear tags, it ended up being a bounce trade and not a new. All the rest of these one taggers were new intermediate trends that started. So maybe this is an indication that we're not going to get the new intermediate trend, and that we're going to actually get, as we did on the last one, a move down to new lows, right? To pass this 4,300 level down towards maybe even 4,200. The reason why it's a bear tag is light green shading in the yellow line, which means we close above a falling moving average. That's why it's yellow. And then we have the light green shading because we rose, but we're actually still just a smidgen below 50. So it's about, it was a very tight window. If it gets above 50, then we have dark green shading and there's no bear tag. So it was a very tight window to actually get that, and we are there. Of course, the near-term line is actually back below the intermediate line after only a couple of days above it. That's and peaking here in bullish territory, again, well below bullish, the reversal zone. And already back in the bearish territory. So it is a lower near-term high point. The expectation is that you'll get a lower near-term low, especially, you were coming off of a higher near-term low, and we did not get the higher near-term high. We actually got another bear tag. So, another indication that we'll probably get another near-term low point where the blue line drops with, a price lower than this one, since we're, like I said, coming off of that lower peak. So that's the S&P 500. The NASDAQ remains relatively more bullish. Its intermediate line is clearly below market sentiment, though, and the near-term line also gave you a bearish peak and is back in bearish territory. Not quite the bear tag. The intermediate line is rising again, that's why you're dark green shading, but just barely. And like I said, it's still below market sentiment. It needs to get back above that market sentiment for you to be strongly bullish there. If you look at the Dow Jones Industrial Average, you'll notice here that it's a little bit more bearish because we never did get above we never did get the bear tag here. And we haven't again, we're failing again at the moving average. The near-term line did, drop back into bearish territory. It got a little bit higher, but it's back down there, and it's actually slightly below the intermediate line as well, and the momentum line is oversold. So you can see that one's not nearly as strong as the other large cap indexes. And if you look at the small cap index here, it's the most bearish of all. In fact, its intermediate line, we formed a cluster a couple days ago, and we're lower than those lows now. The momentum line's still in the reversal zone. So you've had quite a few days here in a row. 1, 2, 3, 4, 5, 6, 7 days now with the momentum line down there in oversold territory, and the near-term line has been in bearish territory, not in the lower reversal zone, but in bearish territory that entire time as well. So that's a pretty extended bearish near-term, short-term move to the downside. You can see down here you had a few moves where at least the momentum line got out of the reversal zone, even if the near-term line kind of stayed in bearish territory the whole time. But that's not the case here. So that's it's more of a bearish decline than what we've seen in the short term. We're only 2.2% below the moving average, but it is dark pink shading and a red line. It's clearly bearish, and it is the lowest close. I mean, remember the idea was that we would close below these lows on the S&P because of the failed bear tag. Well, the Russell did fail with that bear tag, even if the S&P is producing another one right here. The Russell did and now is closing. Now it's not closing below these lows yet, but it is the lowest close for the Russell. So we are starting to move towards those lows. So again, another reason why you would expect the S&P probably and the NASDAQ to catch down to where the Russell 2000 appears to be leading it. Now let's take a look at some of these other indicators. Let's look at the long-term weekly chart. And again, we got a lower high last week, but we did get a slightly higher low. So kind of like that, that intermediate, not quite a transition like this one, this candle here, but kind of that pre-transition like you got over here for an example, where it wasn't quite a transition, but it was a lower high, slightly higher close, and then we got the transition. Well, now it definitely looks like we're getting a transition. It is a slightly lower close on the Heikin-Ashi basis, definitely a lower high point. The Heikin-Ashi differential is crossing below its moving average. The PPO is continuing to fall. Still a golden cross environment. Keep in mind that the Russell 2000, if you look at it, its Heikin-Ashi is closing below the 40-week exponential again, so the 200-day moving average. You'll see that here in a second, and its PPO is down to down to only 1% now. So this is not the greatest sign, and obviously clearly after two transitions, not turning bullish, we've turned right back down to being bearish on the Russell, and potentially closing as of right now, closing below that low point and really getting the reversal where you'd expect more bearish candles here. If we look at the three green arrows, you'll see that we are still kind of flirting. We got red arrows there. We got a couple green arrows on the S&P. The NASDAQ now does not have three green arrows. So yesterday we got the red arrow on the stochastics that continued down today. Of course, the Dow never did get three greens ever. So it's still, but it's still not, at least it's not in three reds yet. It's still actually got two reds. The MACDs on all of these are all green. The only one where the MACD is red is the Russell, and it did get three reds here a few days ago, and it's continuing with those three reds now. The stochastics there in bearish territory, the lowest stochastics. I mean, shoot, you have a green arrow on the stochastics there. This stochastic's still in bullish territory, and as is the Nasdaq's. So not only is it not green, but it's the only one that's actually in the lower reversal zone. So again, you can another indication of just how bearish that Russell 2000 is. If you look at the two-line version of this chart, you can see, I mean, the range, as small of a range that we had today of only what 2 2/3 points. The range was traversed by every single one of the moving averages, except for the 200-day that we look at here. The 8 and 17-day there, we actually did close slightly above the 17-day. We are still, I mean, pretty much trading inside the range. The open and the close was inside the range of a small gap between the 30 and 50-day moving averages. The 30-day has crossed below the 50, so kind of a bearish cross there, even if this 8 and 17 are actually still above the 30. It's kind of a divergence there, but still very small range, very weak volume, especially considering a CPI day, probably one of the smaller ranges that we've seen on a CPI day. The stochastics is still in bullish territory, but below its moving average. The MACD is pretty much sitting on, it's still above zero, pretty much sitting on top of its moving average. Obviously, we don't have a green arrow, so it's not below its average yet. And like I said, still positive. So nothing too bullish there, but not too bearish yet, excuse me, there on the S&P. But if you look at the Russell 2000, it actually closed below its 200-day moving average. None of its moving averages are converging on each other. They are clearly widened out because we are in a pretty directional move. The MACD is falling below its moving average. It's negative. Stochastics is falling below its moving average in bearish territory. And we actually had a pretty decent range today, almost average, and about average volume too. So pretty decent move, and again, pretty bearish. Again, the last time we were bearish, as I tweeted out, was back over here on June 5th. And that was on the way up. The last time we fell below the 200-day moving average was over here on March 9th, March 10th, during the banking crisis. And we stayed below the 200 for a couple of months before getting back above. And then now here we are again, back below the moving average. So, we've definitely taken, and by the time we were below the 200-week, we were still a few days away from the 30 crossing the 50. The 30's already crossed the 50, as we're sitting here. So a little bit more of a bearish environment with a lack of volume here. So a pretty easy move down to potentially 175 on the Russell. Again, we've already done this year, but it was with the banking crisis then. It's not the same now. There's no crisis here. It's just bearish. There's a lack of bullish sentiment for at least this part of the equity markets, which is not necessarily the best sign. The S&P is sideways as it is. Both of its DMI indicators are below 25. So again, no trend developing. The ADX is really, really low. It's the lowest it's been since we went sideways over here with that little convergence pattern. So it's a really, really low ADX. Again, not the case for the Russell 2000. There's clearly a bearish trend developing. The ADX is rising above 20. You have the we're not above 30 at least on the negative indicator, but we are below 20 easily. And above 25, so we're clearly got a trend developing, even if it's not the strongest trend. You look at some of these other oscillators like the RSI and the CCI. The RSI is flat as a pancake on the S&P, and the CCI is pretty much right at zero. So again, showing just how neutral the S&P is. Not the case for the Russell, breaking below 40, easily below zero, and back below minus 100. If you look at the weekly chart, remember, getting below minus 100 is a pretty decent indicator of things changing the trend, right, of starting a correction. We've had a couple of those instances here where it pretty much set the low point, right, there and then over here. But over, when we hit the 100 level a few times before, and then we hit it this time that started the correction, it's almost kind of a similar feeling now as to what we had in 2021 after kind of a false breakout. We didn't quite get a false breakout on this, like getting back above 2000, though we did get some breakout moves that appear to be relatively false across a bunch of other equities, especially considering the divergence you had on this weekly CCI here on the Russell 2000. So let's take a look now at at the Ichimoku cloud. So for the S&P 500, we are flirting with a weak trend developing, a weak bearish trend developing. We're almost at 50. We're almost below -1. So we're right there. We are inside the cloud. We kind of failed to get above the cloud there on the S&P. The Russell is below its cloud, clearly bearish. But we don't have a trend. Like, it's still below. It's close. It's close to 50. It's close to -1. But we're not there yet. And the rate of change is clearly negative over the last 26 days. And you can see, like, there's quite a big gap here. In fact, the gap is increasing. It's getting bigger on the pink shading. It's not turning green anytime soon. That's not the case for the S&P. I mean, we're so neutral that the gap is actually really, really neutral. But we haven't turned green yet. So, you know, a lot of that has to do with what we're seeing in the Qs, right? The Qs is really flirting with being green. They're pretty much sitting right on top of each other. So it's really close. Despite the fact that we're actually closer to a bearish trend and we're still in the cloud here, but we are above those lines. Your diamonds, interestingly enough, it looks pretty similar and never did get the pink. Like, we're still green on here, so we still don't have the crossover yet, despite, you know, the lack of a bullish trend and a pretty negative rate of change. We still haven't got that crossover yet, so we still haven't been bearish enough to really, you know, show a bearish crossover on the cloud itself. Let's take a look at the Bollinger Bands and the Keltner channels here. You can see, again, the bandwidth is really low. It's not the low as it's been the last little bit, but relatively speaking, for the past year, that used to be a low point. The S&P is sitting right at the middle of its bandwidth, right at the middle. So really neither bullish nor bearish. What's interesting is, while the bands are outside the Keltner channels, and you do have some positive momentum, it's very weak if you look at these other momentum jumps that we've had. Very, very weak momentum, but you also have the Keltner channels moving inside of each other, so which is not very common. So that's a pretty interesting pattern that you see there. Very sideways neutral pattern on the S&P. Obviously not the case on the Russell. The Russell is, you know, in the lowest quartile, pushing down against the lower band. The bandwidth had pulled back, like we had gone pretty neutral here after a jump up in the bandwidth here on the last decline. That we had some negative momentum there. The bands came inside the Keltner channels, but instead of reversing to the upside, as you would expect with some positive momentum, it appears that we may be starting to increase to the negative side again. So, you know, again, like we expect the S&P to do with the bear tags it's produced. Remember, that was a bear tag on the Russell 2000. It either starts a new intermediate trend, or it has a pretty decent move in the continuation of the trend to new, either in this case new lows, or in the opposite case for the bull tags, up to new highs. Let's take a look at how the intraday moves. Very small range. Remember, we had a very small range the last, really every day this week has been a really small range. They're pretty much sitting right inside of each other, right in the middle of last week's range. So we haven't broken out one way or the other. Again, I can't stress enough how bearish this pattern is. A one touch at the 100 level, which means, again, that we, after being bearish, after a typical intermediate decline, we get a new four-week high point on one day and then never again. You know, that's not common. It's common for it to come down after maybe one or two touches, but usually we come right back up. And you can see a lot of examples of that. For it to one touch and then come down below 70, just like that, that's not very common, or 75, or 70. That's not common at all. And your red line's almost to zero, which means this tag's almost all the way over. So again, we are setting up here for a bearish, I mean, this is the pattern that you would expect. You know, again, when the green line crosses zero and the red lines hit zero, or the green line crosses below 70, the red line hits zero, that's when you're susceptible for that kind of spike. And we are susceptible for that kind of spike, but only coming after a one touch on the green line hitting 100 is, like I said, it's typical. The few times we have seen that pattern occur has occurred not just in pullbacks, but actual corrections. Again, you know, for those of you who aren't as familiar with my videos, for me, my definition of correction is when we fill in the gap, when we make a move down to the 200-week moving average. And a bear market is when we break the 200-week moving average and stay down below that. You know, of course, this is a correction, even though we did get below it, because we didn't stay below it. We immediately jumped back up above. But any of these moves that make it to the 200-week moving average, this included for that matter, would be a correction, like we had in 2022. It was a correction to get down there. So these kind of moves I talk about here, like on the Arun, is typical of moves that get you to the 200-week moving average. And remember, the Russell 2000 has been more bearish. It is at its it's not just crossing below its 200-day moving average, but it's also crossed below its 200-week moving average. The MACD is negative, the stochastics is negative, flirting with bearish territory, and close to breaking below 30 and 50-week. I mean, this is about as bearish as you can be on the Russell 2000, to be below both the 200-week and the 200-day moving averages. Let's take a look at the VIX, and of course the VIX just is not showing any signs of any concern at all. It's at a low level, well below its moving averages. It's at the 85% mark relative to the VIX 3M. The VVIX did not drop very much. We are coming off a relative low point on correlation with the VVIX. So like this is not common for, like, if you look at like the past 5 years, we've had a lot of time here with the VVIX being below this 50% positive correlation, and quite a bit of time, multiple instances of getting below zero. It's kind of similar to what we saw in some of these other years, but you can see for the most part it spends more time above 50, and that actually hasn't been the case this year. I think there's been a majority of time, but really since April, I don't think it has been the majority of the time above 50. There's been a good chunk of time where it's been below. So, that just goes to show, again, how much we are set up for volatility to have a jump to the upside, especially when you consider how compressed it is. When you look at the VIX relative, the ATR of the VIX relative to where its value is, it's been below 10% this entire time, just like it was at the end of 2022, beginning of this year, preceding the big jump in volatility we had with the banking issues. I mean, that was probably just a tremor, whereas the big earthquake is still yet to come. This is a sign. We can't accurately predict when volatility tsunamis occur, but you can analyze the conditions that typically lead to one, and one of those conditions is how compressed it is. And the ranges have just been, relative to its value, its ranges have been really, really small, and that's, you can see if I were to zoom out here for some context on this, you can see in how after the beginning of 2018, we were never below 10%, except for when we had these big spikes in volatility. Those are the only times we got to 10%, and then it preceded these jumps. So lately, we've been below 10% for quite a while, very similar to 2017. And again, that preceded a big change in volatility. So this kind of volatility tsunami here, we don't know when it will happen, but the only thing we can know is what typically leads to that. And this is the kind of conditions, especially considering it's been pretty much more than a year that we've been mostly below 10. That's the kind of conditions that sets up for that kind of spike. And that's actually not that bad of a spike compared to some of the others that we've seen before that. All right, now let's take a look at what's driving this price action. As you can see, over the past 3 months, commodities continue to be the big mover. Not so much today. It was a big mover early in the day today. And if I were to take a look here at September and then just look at today alone, it was a pretty strong move, and eventually things came back down to it. Like, it started off strong, pulled back, and then other things now obviously came down. The Qs were the big winners. Again, small gains, so nothing too major. Obviously, the IWM was a big outlier to the downside. The S&P was briefly negative towards the end of the day before a late rally, where bonds actually fell. Interestingly enough, that stocks rallied when bonds fell. So that means obviously bond yields were rising during that period, and hasn't been typical. Obviously, international equities and not doing so hot today as the dollar was pretty flat, but that put some pressure on these international equities, and gold in particular, and real estate. That's the outlier to the downside. Real estate really getting beat up pretty badly. When you take a look at the 12 grid for these different asset classes here we go. I look at the 12 grid for all of these, you can kind of see what's pushing a lot of these prices. Sorry, here we go. You can see emerging markets and developed markets are kind of in bearish mode, a little bit more bearish than what we're seeing in the U.S. But real estate is really bearish, right? It's really coming down. These REITs are in bearish levels, similar to long-term bonds. Long-term bonds are in bearish levels too. You can see what's going on with the dollar down there, and gold. Crude oil, very strong trend to the upside, as well as the 10-year yield. You can see was actually down slightly today after being pretty strongly up earlier in the day. As like I said, the yield started off strong with those commodity prices, but then pulled back by the end of the day. If you were to take a look at Bitcoin, you can see it's also maintaining its own bearish trend right now. So you can kind of see, like, there is definitely a move towards risk aversion. There's not a whole lot of risk appetite. It's really kind of in the U.S. markets, and it's mainly in the U.S. Equity markets. Like, that's the large cap stocks in particular. As we take a look at the ratio chart here, you can see that the ratio is hit its barely, but it hit its highest level again. So the Qs continue really to outpace small cap stocks. It's been pretty much since the financial. Here's the financial crisis that we had, the regional banks and their issues that they had in the early part of March. That's really when at that time the Qs were underperforming the Russell. It was a pretty bearish. Remember, the Qs finished the year at their lows, 2022, and they really took off. They started the year okay relative to small caps, but they really took off from there, for the rest of the year. But that's what really propelled it to the upside, and you can see going into really that June expiration where the Qs went parabolic. And then now we're on another run right now, and look, the 30-day average is actually crossing above the 50. So we're kind of on another little run here, but you notice that's not producing a bullish pattern on the S&P 500 as the correlation right now over the past quarter, it's a 63-day correlation, is actually slightly negative. Not too strongly negative, but slightly negative. And again, opens up the idea of, okay, when this correlation returns back to being positive, as it generally is, that means both this ratio and the stock market itself, the S&P, will go in the same direction. Will they both go up to a large degree? Because that's gonna, it's got a big move to get up to higher correlations. So will it go up, or will they both go up, or will they both go down? And considering again just how bullish this has been, especially over the course of this past year, and again for some context and how bullish that move was during the banking issues, it was one of the strongest momentum moves outside of COVID that we've seen. And then we've just progressively getting lower highs on the MACD as we get higher highs on the index. So we're definitely kind of converging with a little bit of a head and shoulders pattern here. So, again, are they both going to go up as this returns back to being positive? Or are they both going to go down? And that's, you're considering that, how bullish we've been. And again, you can see the long-term PPO is more bullish than it's been since the COVID. Like the expectation with the RSI being already high, forming its own divergent patterns, the CCI forming divergent patterns as well, the DMI forming divergent patterns. If you had to guess on both going up or both going down here, you would guess on, especially considering it's at 20 plus year highs. We haven't seen these levels on this ratio since 2000 during the tech bubble, during the last stages of the tech bubble. You would probably guess it would go down to the down, that they would both go down as that correlation turned back up again. Let's take a look at how some of these other, remember how bullish the dollar had been. You can see it's still pretty strongly bullish, and you can see commodities are pretty strongly bullish too. They are slowing down those gains, and that's one of the reasons why the stock market, again, we broke above the 200. After a retest, we stayed above the 200. We're still relatively bull. We're just converging. There's not a whole lot of bullish momentum right now on the dollar. When you look at commodities, especially crude oil, it's still really strongly bullish too, and coming off a very strong momentum peak. And not at the 90th percentile or higher, but pretty strong momentum as well. Stochastics is up there. So there's not a whole lot, like especially as we head into expiration, there's not a whole lot of return, extra return that this can get. So there's going to be some weakness in the crude oil, in the dollar, and probably in the 10-year yield too. That can actually help the stock market in the short term, as long as they're not, coincident with this kind of broader risk aversion, which appears to be the scenario that we're steering towards as equity markets, and as you saw with Bitcoin too, which is the very high end of the risk appetite scale, has broken down to its 200-day moving average. Despite the last 3 days little rally, it's still been in the bearish mode, and it is also below its 200-week moving average as well. So very similar to the Russell 2000. So you can see that the highest end of the risk appetite scale is actually in, quasi correction slash very weak bear market mode themselves. When you look at the sector rotation now, let's take a look at the sector rotation here, and we'll look at the comparison chart first. You can see it, not surprising with commodities being bullish, how strong energy stocks have been. Let's just look at today alone. Today, utilities were the big winner. And utilities have been a big winner for a few days here. You can see staples underperforming discretionary. Discretionary is still bullish there, especially the big names in that space. But your cyclical areas down here, materials, industrials, energy, financials, they all really lagged today. So not only did they lag, but they were negative. So again, kind of shows just how weak kind of the economic sensitive areas of the markets are. We're expected to get a really strong GDP print for the third quarter. That's probably not going to be the same for the fourth quarter, as we're already starting to see some weakness in these areas where the market would start pricing in, pricing that in. You can see that's where the dark pink shading and the red lines are. Industrials and materials. Energy has been a safety trade. Real estate and staples hammered. Utilities getting a bear tag, seeing if we'll end up breaking through that yellow line and the light green shading. Same thing with financials. We'll see if that bear tag plays out. But considering what the Russell did, you wouldn't expect that it would, as these other bear tags have failed and we've continued downward. And discretionary, remember, had been kind of the weaker one out of the three. It's been more bullish here lately, but again, probably not something you would expect to continue, considering that technology is not following the same pattern, and really neither is communication services. All right, well, that brings us to our trade idea of the day. Let's take a look at Marathon Oil. A lot of these energy stocks have been doing very, very well, Marathon included, MRO. You can see, though, we've got a couple bull tags here, similar to when we got a few bull tags up here. Again, it's likely that it's going to be a bounce, like multiple bear tags can be a bounce trade instead of a reversal, and that's kind of what we're seeing here. Multiple bear tags might ultimately end up being more of a reversal type trade. But at the very least, what bullish momentum we had is stalling. The intermediate line's down, but short-term sentiment looks to be improving. The short-term sentiment line is moving up there. The long-term chart for Marathon Oil is showing some transition candle characteristics here, so kind of neutralizing the trend that we had. Looking at the three green arrow charts, you can see we're sitting right here on the moving averages. They're all converging with each other above the 200-day, above the 50 days across the 200-day, sitting right there at the point of control. Pretty decent volume and trading range here lately, at least relative to their averages. The DMI is at low levels, both of them below 25, in fact both of them below 22 for that matter. The RSI and the CCI are both at neutral levels here. You look at the Ichimoku cloud, there's no trend going on here right now. Right there, it's kind of flirting with a weak trend. You're above, but there is, you're above the cloud, you're above these averages, you got a positive rate of change. But no strong trend going, and the Bollinger Bands are reflecting that as well. We're right in the middle of the bandwidth. The bandwidth is rising, but still at very low levels, still inside the Keltner channels. The momentum is not very strong at all. So pretty neutral setup. So what we like to do on these neutral setups is come out and sell, iron condor spread on it. So we'll sell the low 20 deltas there, and then this is the closest we can get to a 20 delta here, at least on the positives, on the 20 or above. At the 31 delta there, we'll do a full contract size, and you can see those break evens are sitting right there, right around the edges. Like there's some, if we're going to reach either one of these break evens, we're going to be directional, either to the upside, which is less likely right now, or to the downside. If it were to break down there, we'll have a pretty decent bearish move developing. There's some pretty decent support in this area from multiple touches. And then the gap, the bottom of that gap in between earnings there earlier this year. So a good setup with some good break evens, and like I said, a normal position size where we're willing to give up. It looks like, here, let me get rid of it looks like we're trying to make $434. So out of the $966 that we put at risk, we're gonna be willing to lose $434 because that's what we're trying to make. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Follow us on Facebook and Twitter. And like us like our content there on those platforms, as well as join us at marketscholars.com for free. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.